In this video, Morgan Stanley, who just over 3 years ago had a bear case price target on Tesla stock, split adjusted of, let me do the math here, 66 cents per share. 66 cents! Predict Tesla China sales will collapse in the later half of this decade. Will they be right? Or will it be Morgan Stanley's reputation that collapses in the coming years? Plus, more proof that the world is finally starting to wake up to how inevitable and how quickly the transition to EVs is actually happening. And how incredibly far behind legacy automotive manufacturers really are. And before we get into it, if you want to instantly unlock over 100 exclusive videos, plus my 10-year Tesla stock price targets and loads of other perks, including optional access to my Tesla valuation model, join our growing community of thousands of supporters on Patreon with the link in the pinned comment. You can also pick up some Tesla, Elon, and investment-themed merch in the merch store. This from Morgan Stanley, quote, Tesla China update. How much longer can Tesla be allowed to win in China? Before we answer this question, I'd like to ask one of Morgan Stanley. With these absurd EPS estimates for Tesla for 22, 23, and in particular 2024, how much longer will investors take anything Morgan Stanley, aka Moron Stanley, say about Tesla seriously? Now look, for 2022, Moron Stanley's EPS estimate for Tesla of a little under $4 per share doesn't seem to be too far off the mark. Then again, we already have half a year worth of data, so this is not a very long-range prediction. Things get really bizarre going out a little bit further into the future. In 2023, these dipshits, yes, I just want to make sure that people understand this, these dipshits have EPS of $4.45, okay? Maybe about 12% above their 2022 estimate. Yet in 2023, give or take, Tesla will sell about 50% more vehicles than they did in 2022. Now, I'm sure Morgan Stanley would argue, well, the costs are going up, the average selling price is going down. Look, I get it, yeah, cool. Let's just see how well this ages. And by 2024, these guys have lost the fucking plot. Not even $6 in EPS. Once again, I'm on the record. My bet, which makes it very easy for Morgan Stanley to win, giving them a huge margin of error. My bet is that Tesla's full year 2024 EPS will be closer to double this embarrassing guess of less than $6 than it is to $6. I believe their error here is so enormous that I'm confident enough to go on the record. Even if it's 49% above their estimate, they'd still win this bet. But if it's 50% or more, meaning over $9 per share in EPS, I win the bet. And spoiler alert, I'm going to win the bet. Keep me accountable. Come back early 25. Let's see what happened with Tesla's EPS in 2024. I literally cannot believe these clowns. With that said, Morgan Stanley currently have a $383 per share price target for Tesla stock. Of course, I am just a deluded Tesla fanboy, an Elon D-rider, a drinker of the Tesla Kool-Aid, and therefore I don't know anything I'm talking about. In fact, I've never even used a calculator, nor my brain. In fact, I don't even have a brain, so obviously I'm going to be wrong. This bet's going to be very embarrassing in a couple of years' time, and you should all listen to Morgan Stanley because they have a lot of credibility when it comes to Tesla. Awkward time to mention that 66 cent per share price target just over 3 years ago in the bear case? Yeah, I thought so. Let's read on. We believe Tesla is passing through its peak China dependency stage over the next 12 months. In fairness, absolutely right. They're scaling up production in Berlin, plus another US factory as well. At one point, Shanghai was accounting for significantly above 50% of Tesla's annual vehicle volume. In the coming quarters and years, this is going to diminish enormously. Capacity growth in the US and Europe will be paired with far higher levels of vertical integration, turbocharged by tax incentives and production subsidies, where Tesla appears to be uniquely advantaged. Why would that be? Because they're uniquely further ahead on the transition to EVs. Domestic Chinese EV names cannot be ignored by Tesla shareholders. Tesla China is facing its biggest ever competition in China. I mean, I laugh, although this is true. There are a ton of EV companies in China. Some of them will be successful. Some are actually even competing with Tesla in similar price ranges with similar features and functionality. The closest thing Tesla has to legitimate competition is abso-fucking-lutely coming from China, driving the company to increase its long-awaited promotional activity in the China market. Although Tesla has been successful in lowering the delivery time to 1 to 4 weeks from its 4 to 8 weeks previously amid rising production, our China auto team says Tesla started offering a subsidy of $1,140 to its customers who have already reserved a Model 3/Y. This subsidy, available only to customers who purchase Tesla insurance, is available from the 16th of September to the 30th of September. Hopefully it doesn't take a genius to figure out why Tesla would be doing this. This is a logistics play. They're trying to incentivize customers with higher margin purchases take delivery of their vehicles in this quarter. Hence, this incentive being available from the 16th to the 30th, the final 2 weeks of the final month of the third quarter. According to local media, Such promotions could help urge consumers to lock in their orders and smooth the pace of deliveries into peak season while enticing new customers into the brand at more affordable prices to complement shorter delivery timelines. One step closer to stranding joint venture brand ICE capacity in a rapidly electrifying Chinese auto market. According to Morgan Stanley China Auto Analyst, such promotional measures are relatively common in the industry and should not come as a surprise. The market has been looking for more promotion from Tesla China since August, after the waiting time of its Model 3 and Y reportedly shortened in the wake of an output upgrade at Gigafactory Shanghai. We look for more premium EV players to follow suit, likely pressuring sales of foreign joint venture brands' ICE products, including those luxury models, into Q4, and forcing local dealers to react with more aggressive promotions. Apart from Tesla, several other popular Chinese domestic EV companies that have a competitive model pipeline are going head-to-head with Tesla, such as NIO, XPeng, Li Auto, etc., are already feeling the pricing pressure. XPeng, which recently started offering big discounts at its centres, provides discounts of $2,200 on the new P7 model and up to $1,500 on smaller models, the P5 and the G3. Li Auto is offering $1,030 discount on its Li 1 ER EV model. Tesla's Shanghai factory are ramping fast. According to the recent data from the CPCA, the company reported its second highest sales in the month of August, selling about 76,965 units, of which 34,502 vehicles were sold domestically and 42,463 were exported. Its domestic sales generally are expected to pick up during the last month of the quarter. This is an important point, as Tesla restores local deliveries during the last month of the quarter before they switch back to international deliveries. Again, this comes down to logistics. Early in the quarter, a lot of the vehicles produced in China are being exported. These things end up on rail and or ships, can take a very long time for them to actually be delivered. So Tesla times these vehicles with a long delivery process earlier in the quarter, so they're still delivered in the quarter, and then switch to more local production and sales toward the end of the quarter. It doesn't take as long to ship a Tesla to somebody in Shanghai that's produced in Shanghai as it does to ship a Tesla to somebody in Timbuktu that was produced in Shanghai. We expect domestic deliveries to rise further this month after a production upgrade. The highly competitive electric vehicle market in China is valued at $124.2 billion in 2021 and is expected to grow to almost $800 billion in 2027. Per EV volumes, China currently accounts for 62% of the total global battery electric vehicle sales on a year-to-date basis. Tesla market share is around 9% year-to-date in China, giving way to the non-luxurious and low-priced $5,000 brand Wuling. For those who can't remember, these are the tiny death machines on wheels. Technically, they are an electric vehicle, but the size of the battery in these things, about the same as you'd find in a vibrator. The safety features? What safety features? Like I said, it's a death machine on wheels. So technically, this is an electric vehicle, but it is worth putting in its own category. It's absolutely not competing with Tesla. These are meeting very different needs of very different consumers. You can almost think of this as a luxury scooter. And don't get me wrong, these have a place. It's a fantastic thing to be producing if you're not concerned about consumer safety, which is why Tesla's never going anywhere near these little death machines. But it's important to understand, if you just look at the numbers, it looks like Tesla's getting slaughtered in China. But when you understand the actual product that's being delivered for the price, they're not the same thing. This is not apples to apples. However, Model Y remains the second most popular model in China. Again, if we remove the Wuling Mini here, it's actually the most popular electric vehicle in China. Imagine that. Foreign company with the most popular electric vehicle in China. And again, for some additional context, Tesla is making more than $5,000 profit per Model Y sold in China. I don't know what the margins are on the Wuling Mini EVs, but if they're being sold for $5,000, it's literally impossible the margin could be any more than $5,000 if they produce it for 0 cents. And Tesla's Model Y also claims the top unit sales among luxury vehicle models, not just electric, but all vehicles. In our view, the remainder of the decade will see a rapid industrialization of Tesla's NAFTA and EU supply chains to achieve compliance with programs such as the IRA and potential European equivalent, which will drive a natural dilution of the role of China in Tesla's demand footprint and supply ecosystem. Again, this is a fair point. I mean, if Tesla goes from one factory in the US to one in the US plus one in China, and then adds another factory in Europe and then another in the US, by default, the China factory is going to be less of a total percent of Tesla's vehicles produced in the future. I mean, the fascinating graph here. Market share of the top 5 brands in China's battery electric vehicle market in 2022. Now, I believe this includes hybrids, so not very useful data. And that being said, we can see Tesla here, 8.9% market share. Very impressive in a hugely saturated market. China's EV market is the most competitive, the most advanced, the most developed, the most mature on Earth. And remember, there's many vehicles being sold here that cost less than an hour with your girlfriend, yet they're still being counted in market share. And some more fascinating charts. Top 5 battery electric vehicle models by market share in China, year-to-date 2022. As we see the Wuling Hongguang Mini Battery Electric Vehicle Death Machine on wheels, 10.6%. First actual vehicle, as opposed to a tiny death machine on wheels, a glorified scooter. Tesla's Model Y, 6.1%. Twice as many unit sales as the next best, BYD's Dolphin. In fact, Tesla's Model Y alone selling about as many vehicles as BYD's 2 best-selling vehicles. This again goes back to the idea, why have 420 trillion different vehicle models when you can just have one category killer per category? And here's where Morgan Stanley make their extremely bold claim of collapsing sales in China from Tesla. Tesla China sales forecast. Now this is sales only, it excludes China units produced for export. This is a very important distinction. They're not talking about how many vehicles Tesla's making at their China facilities, how many are being sold locally in China. As we can see here, Morgan Stanley estimate that Tesla will sell a peak of almost 1 million electric vehicles in China in 2027 before their Chinese sales begin to collapse. They also have Tesla going from a total market share, 2022, of around 25%, collapsing to around 10%. Now, I'm not an expert, I don't know what I'm talking about, but I find this fairly hard to believe. I understand where Morgan Stanley are coming from here. Well, maybe the Chinese government doesn't want Tesla to win. Maybe they're going to make it very difficult for them. I totally get that. Oh, the competition is coming. But China is literally the world's largest automotive market. I find it absurd that Tesla's peak unit sales in China will be 1 million units, not even. Of course, I could be wrong, but this to me just really doesn't make sense. Of course, this isn't the first time Morgan Stanley haven't made a lot of sense on Tesla. Of course, I'm definitely not going to use this as an opportunity to once again bring up the absurd split-adjusted price target in the bear case from early 2019 of 66 cents per share on Tesla. That might serve to diminish Morgan Stanley's credibility, and I definitely don't want to do that. Let me know in the comments below. Can you imagine a scenario in which this plays out? Now, in fairness, even if this is the case, what matters more than how many vehicles is Tesla selling locally in China is how many vehicles is Tesla selling on planet Earth. I suspect over the long term, China is going to be Tesla's main export hub. Hopefully you all understand this. Generally speaking, getting things done in China is cheaper and quicker than most other places on Earth. This means that the margins on Tesla China-produced vehicles will be very high. China can serve as a great export hub to many surrounding areas, including countries where it would make literally no sense whatsoever for Tesla to be locally producing vehicles, for example in Australia. Tiny vehicle market, extremely high labour costs. It'd be brain dead for Tesla to produce vehicles locally in Australia when they can make them in China and export them to Australia. And finally, we have China electric vehicle market size from 124 billion in 2021 to about 800 billion in 2027, compound annual growth rate of just over 30%. Meanwhile, over on the Ball Seep Journal, quote, electric vehicles took off. Car makers weren't ready. Yes, this is true. If only they could have seen this coming and been ready. More buyers are lining up for EVs, catching car companies flat-footed and triggering a race for more batteries, factories, and materials. It's almost like the premise of this article is, the EV transition is happening way faster than legacy automotive manufacturers realized, and now they're scrambling to catch up. No one could have seen that coming, right? Geez, if only they could have. It's not their fault. I mean, it's not like it was obvious this was happening. Automakers racing to turn out electric vehicles have generated long wait lists. Now they must try not to disappoint customers, like Louis Figuera. Mr. Figuera put down a $100 refundable deposit on an F-150 Lightning soon after Ford Motor Company unveiled the electric pickup truck in May 2021, eager to use it for his construction job. But there is a long backlog, and it isn't clear when he'll be able to actually order one. Quote, now I'm thinking, can I afford to keep waiting for this? A few years ago, dopey automotive executives weren't sure there would be enough buyers for plug-in electric models. I do want to underscore this. A few years ago, there was no excuse for not being sure, except ignorance and/or brain damage. Now, they worry they can't build them fast enough, while they intensify a multi-billion-dollar rush to accelerate timelines and bring factories online. This is true. This was also entirely predictable. I mean, literally. Go watch some of my early videos on the YouTube channel. Legacy automotive manufacturers aren't moving fast enough. Watch, soon they're going to announce they're accelerating their plans, they're investing more. Then a few months later, the exact same fucking thing. They're going to keep saying, oh, it's moving faster than we thought. Oh man, we're accelerating our plans. And spoiler alert, this thing is still not done playing out. Stay tuned in a few months, a few more quarters. Same shit, every legacy automotive manufacturer will be continuing to accelerate their investment in EVs, continuing to accelerate their plans, bringing forward their dates for being fully electric and then eventually filing for bankruptcy. Count on it. EVs account for only about 6% of overall US vehicle sales, but that percentage has tripled in the last 2 years. Jeez, who could possibly have seen that? I mean, that's exponential growth. You can't possibly have seen that coming until it happened. It's not their fault. I mean, how could anyone have predicted this? While sales of other types of vehicles have declined, and spoiler alert, soon the term won't be declined but collapsed. Legacy automotive manufacturers don't see this coming either. Government Motors, Ford, Rivian, and other automakers say they have waiting lists of longer than a year for their new electric models. Now, in fairness, This isn't a perfect metric, it's useful to know, but how many vehicles are actually producing on the other end of that is also important to really understand the full equation. For example, Rivian, I think they're aiming for around 25,000 vehicles this year. That's not bad, but that can produce a 1-year wait list. Whereas a company like Tesla, maybe 1.5 million vehicles produced this year. And in some areas and regions, they have 1+ year waits as well. In July, 5 of the 6 fastest selling vehicles in the US were electrics or plug-in hybrids. EVs sold in 19 days on average in July, compared with 47 days a year earlier, and went 4 days faster than internal combustion vehicles. By the way, I kind of feel bad for people today that are buying ICE vehicles. It's not their fault that they don't know what the fuck they're doing. It's not their fault they haven't done the math. It's not their fault they realize the value of this asset is going to plunge off a cliff in the coming quarters and years. I do feel bad for these people though, like really bad. When you don't do your homework, you don't understand what's happening, you might think it's a solid investment to buy an ICE vehicle today. Same people were buying brand new carriages to be pulled around by horses just as the automobile was starting to ramp up. Quote, with EVs, right now it's like you build it and they come. This was from Steven Center, Operations Chief for Kia in the US. He has been surprised, imagine this, he has been surprised by strong demand for the Korean automaker's recently released electric SUV. This is the word of the fucking decade when it comes to legacy automotive manufacturers. Surprised at something to do with EVs and demand from consumers. By the way, Kia going absolutely ballistic advertising this EV6 as well. Kia are a little bit of an EV assassin. They're doing really, really well. Very few people talking about them. Kia confirming they have a 3 to 6 month backlog on the EV6 SUV. Quote, we're trying to electrify the lineup as quickly as possible. Again, this is the theme of the next decade. Legacy automotive manufacturers are surprised by the amount of demand for EVs, surprised by how quickly the transition is happening, scrambling to ramp up production, scrambling to source materials, to lock in supply contracts, to get batteries. And I don't want to labor the point, but they're not done being surprised. This will be a recurring theme until most of them are out of business and a few survive. The pressure is on automakers to grab EV market share early. Hang on a minute. I'm not sure who wrote this article, no disrespect, but they're already late. It's not early. They're already late in trying to grab market share. As our good friend Dan Ives would say, it's Tesla's world and everyone else is paying rent. And narrow the gap with frontrunner Tesla. Executives from Government Motors, Ford and VW have all said they believe they can pass Tesla. They have all said this, but none of them actually believed it. Talk's cheap, actions are what matters. Over the summer, Volkswagen ousted Chief Executive Herbert Diess, in part, for stumbling on a software strategy that delayed some EV rollouts. They ousted him because he was saying what needed to be said, doing what needs to be done, and the software issues were an excuse to oust the only hope they had of surviving the decade. Car companies find themselves behind in the supply-demand balance in part because they're morons. Oh, sorry, I misread that. Oh no, I mean it was true, but that wasn't what was in the article. In part because many lowballed early EV production volumes. Hesitant, aka scared little bitches with no courage and or brains and or insight and or vision, and now they're paying the ultimate price. Hesitant to go big on a technology that carries skinnier profit margins than internal combustion engines. If your brain doesn't work, then this is true. There was a grain of truth in this, because this is a crazy idea, I know, but until you've successfully ramped up to high volumes on EVs and innovated in manufacturing, you're not going to be making the same profit margins as your already well-established, fully refined internal combustion vehicle technology, of which you're selling many millions of units per year versus zero of your EVs. For any legacy automotive manufacturers to have thought this was a valid reason, EVs aren't profitable until you're making millions of them, and we're not sure if there's demand for millions of them, so we're not going to do it. This was not a reasonable argument for not producing EVs. Obviously, ramping up a new complicated manufactured product, you're not going to make any money on these until you're at reasonable volumes. And then of course, you've got to innovate in terms of manufacturing and drive your costs down. This is a necessary step to the process of profitability. If you're not willing to take that step, you're destined to go bankrupt. When EV demand took off during the scamdemic, by the way, just to be clear, people get really mad when I say scamdemic. The plague was real. The response was a scam. When EV demand took off during the scamdemic, it caught many auto executives off guard. It sure did. Although, again, it shouldn't have, but if you're blind and or stupid, sure, you'll be surprised by this. If you guys are curious, and I really do mean this, go watch some of the videos I made during the height of the plague, the fear, the uncertainty, and the doubt. Literally talking about what would happen with EV sales during that time. I mean, I literally called it. Yet these auto executives were surprised at the same time. The industry is rolling out its first significant influx of EVs, including pickup trucks, sporty SUVs, and off-roaders. Vehicles that have resonated with buyers to a greater degree than the small, utilitarian EVs of the past decade, which were mostly just compliance cars, not serious attempts. Rising gasoline prices have also stirred interest, but it can take more than a year to boost factory production beyond original targets, often requiring new factory equipment and getting thousands of suppliers to line up more parts. This is true, and automakers have found themselves hampered by insufficient supplies of critical parts. Again, when you don't do the math, this is what happens. Guess what? I know I'm repeating myself, but it's going to keep happening. The same shit that they've seen and experienced in the last few years, it's going to repeat and repeat and repeat until they realize how quickly the EV transition is happening. Until you have automakers coming out and saying by 2025, 6 or 7, we're going to be 100% EVs, you know they're still massively underestimating how quickly this happens, and they'll be facing these exact same hurdles. Electric cars use more computer chips than internal combustion engine vehicles and are especially affected by a chip shortage that has hobbled the auto industry. Someone should probably tell that to Tesla, they seem to have been fine. Quote, there was an assumption that if EVs end up selling well, we can ramp up our production. Quote, that hasn't been possible in the last 2 years. Batteries are another bottleneck for automakers straining to increase EV output. This is the understatement of the century. Locking in contracts for battery cells on short notice from among a handful of global cell manufacturers presents a big challenge. Massive understatement, said Darren Palmer, Ford's head of EV programs. When Ford decided last year to double Lightning production, surprise, well, there's more demand than we thought, better double our production. It had a task force scouring the world for supplies, he said. Government Motors has marketed, I love this. By the way, let me know in the comments below if you saw a GM ad for a GM vehicle, like a Government Motors vehicle, in this video. Another sign that this company is completely f***ed. They're wasting money advertising to Tesla fanboys and fangirls who won't ever even consider buying a GM pile of excrement. I think it costs them about 2 cents for every ad they show to you guys. I get about half that. So if you want to accelerate GM's bankruptcy, just, I don't know, set up a playlist of all my videos to play automatically while you're asleep tonight. GM's going to be pissing away money trying to advertise their vehicles to you while you're not even watching. Don't do that, that's very mean. That executives say will quickly give it the broadest electric vehicle portfolio in the US market. Now this is hilarious because GM are touting this as a strength, having the most models in the US market. If you understand business, economies of scale, this is not the play. Tesla, one category killer per category. GM announced plans to allegedly make vehicles in every category, but not just one, 25,000 different versions of vehicles in every category. Why? Because who cares about buying parts in common, getting bulk discounts, a lot of overlap in the production system? Nah, who cares? Fuck all that. That's why Apple has 60,000 different versions of iPhone. But the launch of the first two of those entries, the GMC Hummer pickup truck and the Cadillac Lyriq SUV, has been slower than comparable vehicles from rivals. Yeah, imagine that. Government Motors, GM, with all this experience, the Tesla killer, struggling to ramp up their first couple of EVs. But I thought legacy automotive manufacturers already knew how to make EVs. Just as soon as they decide to make them, that's when they make them. The company has been making both the Hummer and Lyriq at rates of less than a dozen per day, people familiar with the matter said, despite waiting lists that stretch into the tens of thousands. You did it, Mary. Output at the Detroit factory where the Hummer is made and at GM's Lyriq plant in Tennessee has been constrained by battery suppliers, a GM spokesman said. Imagine that. They don't have enough batteries. Why would that be? Oh, that's right. Because they underestimated how quickly the EV transition was happening. They didn't lock in their long-term supply contracts for batteries. And now, when they go knock on a battery manufacturer's door, hey, can we get some batteries? The battery supplier says, yeah, sure. Once we finish supplying our long-term contract to Tesla, you dumbasses. Should have asked 5 years ago. The batteries needed to increase vehicle production should flow with the recent opening of an Ohio battery factory GM built with partner LG Energy Solutions. Better late than never. Quote, unfortunately, the production isn't there because we're ramping up the supply chain, GM financial chief Paul Jacobson told an analyst in August. Imagine that. Not having supply chain in place because you underestimated the transition. Recurring theme. Chasing Tesla. Automakers' pivot towards battery-powered cars coincided with the meteoric rise of Tesla's valuation, which is more than twice that of Toyota, VW, and Government Motors and Ford combined. Tesla accounted for about 70% of all US EV sales in the first half of this year. Makers are also responding to tougher tailpipe emission standards globally and the influence of green-conscious investors. But some executives from traditional car companies acknowledged they were too cautious on their early plans for electrics. Quote, we sat around and said, who really wants an electric truck? We don't know. Stunning honesty here from Mr. Palmer, adding that Ford determined manufacturing targets around 3 years ago. Ford, in 2020, completed a relatively small factory alongside its oldest plant to produce about 40,000 F-150 Lightning pickup trucks a year. Executives doubled the target last year as the waitlist grew. Oh, I'm so surprised. In January, they doubled it again. Oh my gosh, can you imagine that? Massively increased twice in a very short period of time. It's almost like they underestimated EV demand, and then when they increased their estimates, they'd still underestimated it. And guess what? It's going to happen again and again and again. In January, they doubled it again to a planned annual rate of about 150,000 trucks by summer of 2023. Now, spoiler alert, if Ford was making 500,000 of these things now, they'd sell every single one of them. They might even be able to sell 750 to a mil. Make sure you get in while you can, Ford. Once the Cybertruck hits roads, game f***ing over. Quote, the cement had barely joined to some of the walls, Mr. Palmer said. Quote, and we were already expanding. Theme of the decade. VW's Mr. Deese, during his 4-year tenure, had outlined big plans for VW's shift to electrics, earmarking tens of billions of dollars for EV technology. Mr. Deese marveled publicly at Tesla's progress and hosted Tesla chief executive. He's not the chief executive, guys. He's the techno king of Tesla, formerly the chief executive, Elon Musk, last year to speak via video conference to a few hundred VW managers. But VW suffered delays in getting some new EV models out, partly because of problems with new software. The snags raised doubts among some VW board members about his ability to execute on the company's transition. Now, spoiler alert, every legacy automotive manufacturer is going to have the same problems. It ain't just VW. They were just early enough to be the first to really encounter these issues. At Government Motors, incompetent CEO Mary B.S. Barra has been pressing her team to accelerate several EV programs from earlier plans, including the recently launched Cadillac Lyriq SUV and a plug-in version of its top-selling gas vehicle, the Chevrolet Silverado pickup truck. She has said, quote, "Every vehicle I look at, I'd like it to be out fast," Ms. Barra said in a June interview. Startup EV makers such as Rivian and Lucid have had an especially tough time launching new models. Rivian cut its production forecast earlier this year, citing part shortages. CEO RJ Scaringe in August told Wall Street Analyst that the company's lone factory in Illinois hadn't been able to schedule full work shifts because of trouble getting components, saying output would improve throughout the year. A Rivian spokeswoman said the company had stood by its reduced forecast since March, despite continued supply chain challenges. Lucid, with an electric sedan that some reviewers have compared favourably to Tesla's Model S, has said it has at times been unable to secure parts that normally are in ample supply, such as carpet and glass. Sounds simple, right? But as we know, production, not easy. Lucid in August halved its estimate for 2022 production to between 6,000 to 7,000 vehicles. The second time this year the company reduced its forecast. Lucid, unsurprisingly, declined to comment. Just for the record, at the same time legacy automotive manufacturers are doubling and then doubling again their production goals, we're going to see new EV startups and some legacy automotive manufacturers halving and then halving their actual production targets once they try. Battery arms race. Long term, the big challenge will be batteries. No shit, Sherlock, says Analyst, who predicted that shortages of battery raw ingredients could curtail automakers' production plans as early as mid-decade. In this sense too, the rest of the industry is chasing Tesla, which has spent more than a decade developing a battery supply chain and jointly operates a factory with partner Panasonic. Again, this is a great point. Underrated, something a lot of people don't appreciate. Tesla literally has spent a decade plus developing a battery supply chain and also securing long-term contracts for critical materials and resources, including battery cells. Never mind developing their own in-house battery design they're currently ramping up in Austin and Berlin. Within the past year, Government Motors, Ford, Toyota, and others have signed deals to build more than a dozen new US battery factories. Panasonic is eyeing Oklahoma for a roughly $4 billion battery cell plant after outlining plans for a similar facility in Kansas. Much of the battery cell production and processing of key minerals is done in China and elsewhere in Asia, while provisions in the Inflation Induction Act aim to shift more of that activity to the US. It will likely heighten the competition for suppliers, car executives and analysts say. Prices for nickel, lithium and other battery raw materials have shot higher in the past year, prompting some automakers to raise prices. Some are striking deals with mining companies to extract and process those and other raw materials, a significant departure for automakers, which for decades have had little involvement that far up the supply chain. Again, this is a really important point. Legacy automotive manufacturers are wading into new waters, uncharted territory. They're doing things they've never done before, they've never needed to do before. You can't just assume they're going to do well at it. Ford is investing about $7 billion into construction of 3 battery plants, 2 in Kentucky and another in Tennessee, where it's also building an EV truck factory. In July, it outlined prospective deals with battery material suppliers, from Australian mineral processors to a Louisiana graphite producer. Ford CEO Jim Farley in July warned that only half of the battery raw material the auto industry needs to achieve its long-range EV sales targets are available today. And again, the entire auto industry is underestimating, so keep in mind that what they think they're going to need, and they're only halfway there, is way less than they're actually going to need. Government Motors has struck deals with a Korean company to jointly build a factory in Canada for battery raw materials and signed up a supply agreement to extract lithium from a California lake. GM's EV plan is central to the investment strategy at the Dallas-based Frontier Investment Management Co., which owns about 2.8 million Government Motors shares. We believe that the manufacturing expertise of existing large auto companies like GM gives them a huge advantage, and no disrespect, Richard Soden, principal at the firm that's investing and owns 2.8 million shares of Government Motor stock, but are you serious, bro? Talk about Dunning-Kruger effect. Hurdles to broader adoption, Mr. Soden said, include a lack of affordable EVs and availability of chargers. Tesla's got a great charging network, so scratch that. EV prices have risen more sharply than the broader car market. Ford recently increased the price of its most popular electric vehicles, the Lightning and the Mustang Mach-E, by as much as 18%. Rivian also raised prices earlier this year and recently dropped its least expensive model. US buyers paid about $66,000 for an electric vehicle on average in July, up 28% from a year earlier, according to research firm JD Power. Now keep in mind, given the fact that Tesla has a stranglehold somewhere around 70% of the entire US EV market, and they themselves have increased prices across the board by up to 34% in the last 18 months, the majority of this data in terms of EV prices going up in the US is actually a direct result of Tesla's price increases. And why has Tesla increased prices? Was it due to rising material costs? No, although maybe in part. It was to keep demand in check, to keep the absolutely insane demand in check. Earl Stewart, this is hilarious by the way, a Toyota dealer in Florida, said that there is strong customer interest in the recently introduced Toyota BZ4X FUCK, whose name may have been inspired by one of Elon Musk's recent offspring. Electric SUV, but scant availability. He said mass market adoption of EVs will require more models, including affordable ones. He drives a Tesla Model S Plaid, he said. That's right. A Toyota dealer in Florida admitting to the press, not just it found out or somebody leaked this, he literally admitted that he drives a Tesla Model S Plaid. Quote, until they bring the prices down, it will just be people like me who can afford to buy EVs and who want to be the first on the block to drive one. So let's recap today's video. First, Morgan 66 cents per share Stanley released a new research note claiming they expect Tesla sales in China to collapse starting 2027, never peaking above 1 million units locally sold in China, ever. I don't think that's going to age well, but hey, I don't know anything about anything, so take that with a grain of salt. And now, we really are reaching a tipping point. It seems in the last 6 or so months, people are really starting to get it. This EV transition is happening faster than just about anyone thought. Not only have we seen automotive manufacturers massively increase their production targets over and over and over. Oh, we're surprised at how quick, you heard the spiel by now. In addition, we're now starting to see media observe that automakers were too slow in transitioning to EVs, and now they're scrambling to catch up to Tesla. The most hilarious part of this entire episode is that nobody, apart from the likes of Tony Seba and Rethink X, are accurately estimating how quickly the EV transition will actually take place. Even though they're acknowledging that everyone underestimated how quickly it was happening and is happening, today they're still underestimating how quickly it will happen. I guarantee it ain't going to be that long before we hear yet another legacy automotive manufacturer with a press release announcing they're increasing their production targets, accelerating their EV plans, bringing forward the date to be fully electric in terms of vehicles produced, and then a few months or quarters later, same shit again and again and again. And the reason I'm pointing this out now is so that in a few years' time I can clip this video and say, hey, how come I knew and they didn't? If what I'm saying is true, and even today, despite accelerating their plans repeatedly the last few months and quarters, legacy automotive manufacturers are still massively underestimating how quickly the transition happens. If what I'm saying is true, there are a few very important implications, especially for stock investors. One, until ramped to very high volumes of EVs, legacy automotive manufacturers aren't actually making any money on any of the EVs they're selling. They're suffering massive losses, and in the best case, zero margin. Over time, as they ramp up these volumes, profit margins will increase in theory. If they've massively underestimated how quickly the transition happens, their cash cows, ICE vehicles, which form part of the plan that they were reliant upon to bring in their margins to fund their EV transition, if the sales of these vehicles collapse and the volumes collapse, economies of scale start working in reverse. They're producing less vehicles than they thought. Their profit margins on their ICE vehicles collapse. How are they going to fund their EV transition? Oh, that's right, they'll just raise more debt. But the good news is, at least for legacy automotive manufacturers, until the truly incompetent debt rating agencies, shout out to Moody's, fucking morons, realize what's going on, they'll be able to go to the markets, they'll have a beautiful credit rating, and people will be throwing money at them until they realize, wait, you know what? We might not get paid back. Then these automotive manufacturers get cut off from the markets. What now? Oh, maybe we can just issue some stock, dilute our shareholders. What happens when stock investors realize they're fucked as well? No more raising capital. Next minute, they're bankrupt. Don't say I didn't warn you. Anyway, hope you guys and girls have enjoyed this latest video covering the extinction of the dinosaurs. And lastly, don't forget you can support the channel and unlock a ton of exclusive content by joining Patreon with the card in the corner or the link in the pinned comment. Well over 100 exclusive videos, instant up-to-date access to my Tesla stock price targets, and just for the record, a couple of new juicy Q&As dropping very soon. So, see you over on Patreon. I'm Stephen Mark Ryan, this is Solving the Money Problem, and I love you all. Hey guys, thanks for watching. If you want to support the channel and instantly unlock over 100 exclusive videos, plus my 10-year Tesla stock price targets and loads of other perks, including optional access to my Tesla valuation model, join our growing community of thousands of supporters on Patreon with the link in the pinned comment. You can also pick up some Tesla, Elon, and investment-themed merch in the merch store. And if you're still watching, you're awesome. Please let me know your thoughts on today's video in the comments below, and click the card on screen now to watch the next video.